Becker, Greg Becker, the CEO of Silicon Valley Bank, they have got a challenge. And they've got all this money that they put in there. And what happened was 2022, venture capital cooled off. And some of the venture-funded companies started reaching into Silicon Valley Bank, withdrawing a little bit more money so they could meet their monthly burn rate as they built their companies. This is normal. But guess what didn't happen? They didn't have as many next venture capital rounds to bring them more money that they'd be putting into the bank. So the bank is seeing kind of a depletion from the startups taking money out of the bank. Now, I'm simplifying this, but this is what happened. And they're sitting there at the same time. What started happening last year? Fed starts raising rates. Well, guess what? Silicon Valley Bank is not a hold to maturity client. If they have an issue, kind of like what happened over the last week, they have to get access to the funds. So SVP is sitting on, all of a sudden, what's called unrealized losses, because those bonds that they had a cumulative yield of about 1.79%. Meanwhile, interest rates have gone up to 3%, which means if they try to get out from under that bond or sell it, they're trying to sell a 1.79% bond at the time that the going rate was 3, 3.5, 4, and growing. Means you have to sell all that at a discount, which means you're not going to get $20 billion back. You're going to get like $18 billion back. And I could show you how to discount bonds on Blackboard another day to kind of figure out that delta on what someone maximum price would be willing to pay for that bond. So guess what happens? That's exactly the pinch they were in. So you've got venture capital pressure down, deposits increasing, and you've got interest rates going up, creating the delta. Now, you say to yourself, well, wait a minute, wasn't Silicon Valley Bank traded on the stock market? And when they do earnings report, don't they have to talk about all these things? Well, the answer is yes, they do, but there is a little accounting issue in here, which leads to a lack of transparency by banks and leads to problems. They can leave those on their balance sheet and they don't have to disclose everything about the loss in their quarterly report. And there's a footnote that started showing up in the bottom of the quarterly report that said, yeah, we may have $15 billion of offset losses maybe in there somewhere. Not really worried about it, but perhaps. So it's a footnote. It's not up there and it's not showing up clearly. Well, at the same time, April of 2022, they lose a key person. The chief risk officer, Laura Izurieta, she steps down, and they wouldn't fill the position for 8 months. So interest rates going up, venture capital market softening, deposits getting pulled out by startups, bonds inverting. This portfolio have a bigger and bigger loss, and your chief risk officer is gone. You put all that together, and it brings us to March of 2023. So you could see the storm was forming, but there was also a spark. Everything you saw this weekend, those of you really paying attention are probably going to be familiar with them I'm about to share, but here's something I don't know that people are aware of, and it kind of hid below the surface. I found it in a couple articles, but it wasn't sticking out like a bright headline. You have March of 2023, Greg Becker was interviewed. This is March 1st in LA, and he was sitting there at this invitation-only event, and he said, quote, "We pride ourselves on being the best financial partner in the most challenging times." And why he was saying that? Because he was about to go to London to this big gala and be honored with Bank of the Year, apparently. But Becker at that point had to know about his bonds, had to know about the risk in the portfolio, and yet he makes a statement like that, and then he's going to London to get Bank of the Year. You know what? That would have been like O.J. Simpson going out to get Husband of the Year a week before the murders. Here's what happens on March 1st and 2nd. Around March 1st, 2nd, or 3rd, nobody's talking, but everybody says it happened, but nobody's given big details. Moody's, who had been looking at the fine print and had seen the stock price for Silicon Valley Bank sliding in 22 after the party in 21, they came to them with a message. Hey, you know, we're looking at things and we're looking at your portfolio, underlying stuff, and we're getting ready to downgrade your credit. Now, Moody's and Morningstar, it's critical that you get good ratings. And if you go back to The Big Short, there's a scene where they go and they sit in with a ratings agency, and you have the woman that was there wearing those glasses from the ophthalmologist. They were like dark glasses. And Steve Carroll sitting there saying, well, why don't you properly put the ratings on them? Well, because they'll take their business elsewhere. So that was a corruption of the rating agencies who would put whatever rating on those bonds they wanted in The Big Short. And later, those ratings investors were depending on proved to be crap, and the bonds crashed, and we all know how The Big Short ended. Here you've got a different level with the ratings agency showing up and saying, hey, we're looking at things, and you may be a customer, and you may be a well-known bank, been around for 40 years, but we're going to take you down 2 levels. And like, what do we have to do to make it stop? And he said, well, you need to clean up some of this stuff on your balance sheet. And he said, wait a minute, if we sell the 20 billion bonds right now, 1.79%, almost 4% in the market, we're going to lose, they calculate, about $1.8 billion. This is deposits. These deposits came from all these companies and venture capital startups. We have to go fill that hole. Moody said, however you fill it, it's your business. And they said, well, we would have to issue more stock because we're public and have get more shareholders, have people like buy a big offering of stock. However you do it, if you don't clean up those bonds, you do all this, I'm downgrading you. So this is March 1st to 3rd. A week later, we now know what happened, March 7th, 8th, 9th, going into the week. They started making phone calls. They started calling around and saying, hey, we're going to sell about $2.25 billion worth of stock. Who's in? A company called General Atlantic. Hey, we're in. We've been a good partner with you. You've been a good partner with us. We're in for $500 million of stock. Great. So at that moment, SVB thinks, maybe I'm dodging a bullet. I'm about to sell the bonds. I'm about to have the loss, but I'm going to issue the stock, and I'm going to get the more than $2 billion, plug the hole. So I sell $20 billion for 18. I got to fill this $1.8 billion hole, sell the stock, it fills the hole. Whew. It's Wednesday, you know, bob and weave, maybe I get out of town alive. Well, now we know that the whole plan backfired. And it was triggered by what the rating agency was doing, appropriately coming to Silicon Valley Bank and saying, hey, we need to downgrade you. And by the way, that was the right call, because those bonds that for whatever reason they did, and then not having a risk officer, they're looking at this. What were you thinking? You can't hold the maturity, and why didn't you sell them at some point? Maybe they thought interest rates were going to go back down. Maybe they thought there was a different way in the portfolio. But they had a portfolio that was in trouble, and suddenly they were going to be upside down. Well, guess what? The word starts leaking out on Wednesday, as we know, that they just lost 1.8 and they're trying to raise money. And some of the venture capitalists that are out there, and there's a lot of blame that were put on a couple of them, such as Peter Thiel and Founders Fund, but all they were doing is saying, what is going on down the street at Silicon Valley Bank? We depend on these guys. Many of our companies are in these guys. We're hearing there may be a liquidity crisis. They sold some bonds or something, I don't know. The CFO of SVB was calling key venture capital saying, easy does it, it's okay, this is what we're doing. And in the words of one VC, it was not a compelling conversation. We were concerned and instructed the portcos, portfolio companies, to proceed with finding other banking institutions. In other words, pull their money out. So what happens on Wednesday, all of this becomes public, and there's a huge pull that goes on. And you've got Union Square, Founders, Canaan, and a bunch of other VCs start hearing it, and they say, hey, let's pull out. There's something going on at SVB. That created That created the run on the bank. And then we know what happened. The stock was plummeting on Thursday morning. The bank shares were down significantly. And as a matter of fact, Thursday morning, by the way, this is Thursday morning, all this is going on. And Becker holds a conference call on Thursday morning saying, hey, you know, please stay calm. You've supported us all this time. We've been good partners. You've been good partners. Be good partners now. Hang tight. Nope. By the end of Thursday, what had happened, there were $42 billion in withdrawal requests. And they were showing at the end of the day, with a federal filing they have to make, that they were negative $958 million net. And that's when the federal regulators go, whoa, 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 whoa. Just saw the run, saw what's been going on. You know, this can't go on like this. And so they said, look, despite the bank being in relatively sound financial condition prior to March 9th, investors and depositors reacted, and the regulators stepped in.